there's a lot of focus on what happens with the ECB on Thursday. It's widely expected that they cut. But has the market been too presumptuous that once they cut, they continue cutting almost at every meeting?
Morning, Francine. Well, we've recently reined back our expectation for sequential cuts, and we now expect the ECB to cut this coming Thursday, and then subsequently, probably now in September. What our economists are really seeing is an environment where there's no particular, actually, and it's an unusual environment. There's not particular pressure for the ECB to act in a certain direction. Inflation is now looking like it's moving in the right direction. Financial markets are behaving properly. And obviously, we've got a number of other factors. The geopolitical scene is very active, although not very, very reactive. But I think the most important perspective from our economists lately is they have actually upped a little bit their view on terminal rates from 1.5% to 2%. So that means slightly higher rate for longer, which we think is actually not necessarily a risk or a negative for the European equity market. In fact, we believe that could actually be a paradigm or a setup for equities to perform.
I was going to ask you, Elise, what does that mean for actually, I know you have been very constructive on equities in Europe, but does it remain the case? And do your targets change?
So over the next, essentially, we've seen obviously a strong rally for European equity market, but that's been synchronized with the rest of, with equities in general. What we believe is longer term, we might actually see a different environment for European equities specifically. So pre the global financial crisis, we were in that environment where you had, higher inflation or slightly higher inflation, more around 2%, and we had slightly higher rates. And this is an environment that actually has seen European equities not being this sort of serial underperformer that we had seen. Now, obviously, I'm conscious that, over the last few months, we've had a relatively interesting European equity rally. And in fact, we've seen in the last months, for the first time in 12 months, inflows into European equities. And actually, we are constructive over the next 12 months. We have a balance of risk. We still have some risks. But I think longer term, some of the sectors that make up the European equity markets, like, for example, financials or industrial cyclicals, are sectors that tend to do well with actually slightly higher rates and slightly higher inflation than the sort of zero rates or very, very low inflation environment we had prior to the shocks that we've seen.
So, Elise, how do you build a portfolio? Like, how much is it weighted towards cyclical stocks and industries?
So currently we are overweight, for European equities specifically, we are overweight cyclical stocks. So we are overweight essentially tech, base materials, and also industrials. Probably not autos at the moment, particularly because we're seeing a lot of competition, out of China. But that's for the cyclical end of things. We would favor those three subsectors. And then obviously, should you want some exposure, slight exposure to defensive, we would favor healthcare as our favorite defensive play.
Elise, I know you've also identified three risks or catalysts, and you mentioned China. You've mentioned, of course, geopolitical risk and the fact that there's always a danger that interest rates stay higher for longer. Is there a danger? What's out of these three the biggest danger, actually, that could move around in terms of targets and expectations?
Actually, the largest risk we see is at the moment we have, we don't have any external shocks, and external shocks are the biggest risk we see. So particularly supply chain risks that that we could see. So geopolitical risk, etc., via obviously the communication mechanism of oil are some of the risks that we could see from the outside. But in terms of as far as the market is going, we expect we are right now, we won't have much fundamental news. We'll have that at the H1. We've seen margin holding up, a very good set of Q1. If we sort of ease into that going into the summer, we could be more constructive on EPS growth. At the moment, we're forecasting 6% bottom-up EPS growth, and we could see that consolidated after the H1 results.
Elise, talk to me about margins. I know you put out a very interesting note looking at a breakdown of some of the European companies or sectors and what kind of margins we can expect. Again, is there a valuation play between U.S. equities and European ones?
So obviously, the key question from investors at the moment is constantly around margins, and that's because we have inflation that actually is receding, and usually, margin tend to move with inflation, i.e., if inflation recedes, then you tend to lose that gain you had from higher sales, and those better margins tend to recede with actually receding inflation. So that's a valid investor concern based on history. What we've seen actually is really good margin resilience, and we anticipate that that's likely to continue and be confirmed as we head into the half-year results. By sector, how that looks like is you do have some sectors that have perhaps been challenged in the past that might actually come out better. Again, something that would actually favor cyclical plays and particularly industrials.
Elise, when you look at politics, and it's very difficult, for example, to see some of the policies really in place that will come out of the U.S. election, depending on who's in the White House. But again, is there a danger that actually inflation, there's an uptick because of geopolitical tensions, but also maybe because of protectionist stances that could come in place?
I think I link that's the key question, and obviously that's linked to the view of our economists. What actually is the premises of our view for higher rate for longer is this perspective of the fact that both energy transition, but also geopolitical, what I might call geopolitical transition to a world where security is very important to policy. Obviously, that is inflationary, right? And from that perspective, that's where we end up in Europe, which is highly exposed to the US, with a higher terminal rate of 2% versus 1.5% that we were previously forecasting. That's based on the premise that the world we live in could be slightly more inflationary for longer. Now, obviously, that doesn't come as a straight line, and that tends to come more as a shock to supply chain, and obviously from an energy transition perspective, that could come as a supply chain shock, for example, with a climate change event. But also it comes with policy, with this view that we have to be, obviously here in Europe, we have an election in the UK, and one thing that actually isn't controversial is, I think, the view is that everyone, both sides agree that we should probably have, more spend on defense. And I think that's an unusual setup, which, in the past, it was more bipolarized.